banks, it's very sexy when you close a deal with the bank, and we do that sometimes, but they're very slow movers. They're very slow to execute. They're very conservative. They're never going to be Ripple success stories, and it's hard to get them to push the benefits down to their customers because that's risky for them, and then it highlights where they're inefficient. So we focused a lot on banks in the beginning just because a press release with a bank is a big thing, but we discovered they're just very slow to move. Like if all they want is a press release, now we're like, hey, like we want to actually like move billions of dollars now. And they're like, yeah, we kind of don't.
Hey everybody, it's Eri from Tokyo. This is your cryptocurrency update from Japan, and there's a new video that was released just a couple of hours ago, and it's of, well, David Schwartz, the CTO of Ripple. It's an interview. Yeah, I think it's one of the best I've seen because it's so honest and has so much transparency. I didn't feel like I was listening to a scripted, pre-approved narrative, but just it is what it is. And this channel, which is called The Defiant on YouTube, is also associated with the X account that positions itself as an independent and unbiased news source for covering DeFi. Camila Russo, originally from Santiago, Chile, is wonderful. Yeah, she received her training as a markets and crypto reporter at Bloomberg, and I'd love to have her on the channel someday. They do have a large reach, like 90,000 investors every day with their newsletter, which has a free version, and then there is a upgraded $15 a month version. The video in its entirety is a little over an hour long, and what I did was to save some people some time, which everybody is really always short on time. I've clipped up what I think are some of the best highlights in about 24 minutes. But if you want to watch it in its entirety, I'll put a link to that in the description of this video. All right, everybody, do enjoy. It's a good one.
People were saying that Bitcoin would be great because everybody would just use Bitcoin for everything. But every payment system is great if everybody uses it for everything. The problem with payment systems is that there are so many of them. And so what we started to think about was a payment system that was decentralized, that had the features that we thought were the best about Bitcoin: no administrative functions, decentralization, everybody can enforce all of the system's rules, but that was a multi-currency system that could be faster and cheaper. We also kind of bought into the be your own bank, no middlemen, and miners or block producers are middlemen in the sense that they have interests that are different from the people who transact, like they want high transaction fees. Whereas obviously if you use the system, you probably want low transaction fees. So to focus on this sort of rapid, low-cost payments, cross-currency, cross-issuer interoperability, we designed the XRP Ledger roughly June of 2012. And because it doesn't have proof of work, there's no way that it can allocate currency. So it has 100 billion XRP. Initially, it just sort of sits in the Genesis account. And we built what we thought would become a new approach to global financial transactions. It wasn't that long before we figured out that like institutional adoption kind of wouldn't happen by itself. We're also a key contributor to the XRP Ledger, bringing features like real-world asset tokenization, DeFi, new features like the automated market maker. Our focus as a company has been very much on financial institutions using digital assets, XRP, to lower costs with cross-border payments, using it as a source of liquidity, using it as an intermediary asset. But because it's a decentralized ledger, everybody is welcome to use it, however they want. You can kind of think of Ripple as having two halves: RippleNet, which is like enterprise software for institutional payments, and then RippleX, which is all the XRP Ledger and DeFi stuff. Now, there's advantages and disadvantages of the XRP Ledger's sort of proof of association approach. One advantage is that it's fast and cheap. XRP Ledger transactions can clear in a few seconds. They cost a tiny fraction of a second. There has never been a significant change in ledger capacity, or there's never been a spike in fees because nobody benefits from that. Everybody just wants the transactions to clear as quickly as possible. Now, the disadvantage is nobody has a sort of nobody's paid to do the consensus process, but exchanges need to clear transactions. People who use the XRP Ledger, if you're a wallet provider, if you have any business that's connected with a blockchain in any way, you have an incentive to get that blockchain to work efficiently. And so that cooperation is what keeps the blockchain going. Because it's proof of association, what that means is that if participants are malicious and they're not helping the network come to consensus quickly, people will just ignore them. You can't force somebody else to listen to you. And if people are doing a good job of making the consensus process run smoothly and efficiently, they will stick around. So essentially, anybody who maliciously tries to interfere with the consensus process will eventually just get ignored. And then people who participate, cooperatively will stick. And the important thing is that that is not the XRP Ledger's primary governance mechanisms. That's another sort of thing that we sort of figured out, which is the primary governance method for any blockchain is going to be the software that people run. So in other words, if you participate in the Bitcoin ecosystem, you run a piece of software that determines what transactions you will accept and which you won't. And nobody can ever make your software accept a transaction it won't accept. So like if I wanted to abuse the XRP ledger by, creating XRP or stealing your XRP, nobody would let me do, literally nobody would let me do that. Like there is nobody who has a piece of software on the XRP ledger. I would, certainly, unless they deliberately wanted, if you want to make your software say nonsense, you can certainly make your own computer tell you nonsense. But the software just doesn't allow any sort of abuse. And so the only attack that's left is to sort of slow things down or confuse them. And if anybody did that, people would just stop listening to them. So again, the advantage is it's cheap, it's fast, it's efficient. People are only participating because they want it to be fast, cheap, and efficient. The disadvantage is you could imagine a scenario where there weren't enough people who were willing to run the consensus algorithm. Even though the cost is low, the cost is not zero. So you have a bit of a public good problem. It's like, it's just like if, you had a whole bunch of farmers that had access to some public land and everybody might want to graze on the land so much that they destroy it. And like if we could cooperate, to share that land, we would all benefit. And the factor that sort of helps is there's really no benefit to causing harm. If you cause harm in the ecosystem, you might slow the ledger down. You might even disable it for a short period of time, but you would very quickly just not get, people would just very quickly stop listening to you. So there's really no incentive to attack it. It seems to work quite well. I mean, it's been going on for more than a decade, and it's been clearing ledgers, every 5 to 7 seconds at virtually zero cost. When the XRP ledger was first created, and if you created like a new version of the ledger, the same thing would happen. The software creates what we call the Genesis account, and it puts all the XRP in the Genesis account. So in 2012 or so, when the chain that survived was fired up, it created 100 billion XRP in the Genesis account. The original founders took some of that XRP per an agreement with the company, and they gifted about 80 billion of it to the company, to Ripple. What's also interesting is there were a lot of early participants who also took XRP from that Genesis account. So there actually have some people who have some XRP that's traceable to them basically taking it from the Genesis account the same way the founders did. So the roughly 80 billion XRP that Ripple got was gifted to Ripple by the original founders who took the XRP from the Genesis account. Sort of Ripple's original thinking was to try to distribute that XRP kind of as quickly as possible and sort of give it out to the world. We didn't really originally think that we would be holding on to a large amount of XRP for a long period of time. But it was kind of interesting what happened. As soon as somebody could turn around and sell XRP for money, but when there wasn't a market for XRP, it had a near zero value, and this was true for a long time, a tiny, tiny fraction of a penny. There was no incentive for somebody to try to trick Ripple into giving them XRP or something. People would only take XRP if they had some use for it, if they wanted to experiment with the ledger. And so we did giveaways. We did a giveaway on the Bitcoin Talk forum and so on. And then as soon as XRP was something that you could turn around and sell for money, in an instant, then if we're giving away $10 worth of XRP, someone would be willing to spend up to $9.50 to game the giveaway. And it became impossible to give XRP away. And even when people participated in the giveaway, they would just turn around and sell it because if they wanted it, they would have bought it, right? If they wanted it at fair value, they would have bought it. And so if they didn't buy it, and it became an interesting challenge for us. And as a result, we still have a significant amount of XRP, close to half, more than half the XRP we started with. I think we still have about 45 billion. And it's not a bad problem to have. It's an interesting problem to have, but it's actually surprisingly challenging to use the asset in an effective way to encourage people to use the XRP ledger. Effectively, everything we do becomes somewhat equivalent to selling it. So it's because it is, if you can trade $10 worth of XRP for $10 and $10 for $10 worth of XRP, you're sort of indifferent to those two things. You treat them as effectively having the same thing. And money is hard to it's hard to give away. It's an interesting situation that we're in. And so we've continued to build the payment system. And we're launching a stable coin because the XRP Ledger doesn't have any high quality stable coins, and evidence seems to show that like stable coins are instrumental to DeFi, adding new features to the XRP Ledger. And then we also have this big pile of XRP. You have to be careful to make sure that you actually have something, and you don't always know for sure. NFTs were really big for a while, and there were many use cases that during the hype cycle looked really, really exciting. And now some assets like, the carbon markets and certain collectibles, assets that are connected to games that allow you to do things, assets connected to real world, events. Those kinds of things look like, sometimes you don't know in the short term what's going to work and what's not. We do definitely, we do grants. And some of those companies use those grants for customer acquisition, and that's perfectly legitimate. But again, you just have to be careful to make sure that you aren't just getting people in, you aren't just paying people to come in the door, and then as soon as the incentives stop, they'll go away. You just have to vet them carefully. We as a company, Ripple, don't like just try to spread a token everywhere in the hopes that like some of it will land with people who will do something constructive with it. And at first, we just wanted to get as many customers as possible, and we wanted to understand, how they were using the network and where the opportunities were to use XRP and digital assets for settlement. And then for a long time, our focus was exclusively on customers that would use XRP for settlement. Today, it's kind of somewhere in between those two approaches. It's difficult for us to use XRP for settlement in the United States right now because of litigation issues. So a lot of our expansion has been in the Middle East, in Asia, South America, Europe, in those kinds of areas. The only reason why people generally wouldn't want to use a digital asset for settlement other than regulatory issues is volatility, because the price, can change. You don't have to hold the digital asset for more than, 80 seconds. And if you think about the volatility of XRP over 80 seconds and you compare it to like holding Mexican pesos through the weekend, right? Even though XRP is more volatile than Mexican pesos, XRP in 2 minutes is not more volatile than Mexican pesos over a holiday weekend. The other advantage is that many payment solutions either have high cost because you're using other people's capital, or you have to keep piles of capital in every corridor that you might want to pay out in. So if you wanted to pay out in Mexico, you might have to keep Mexican pesos in Mexico. But if you don't know how many Mexican pesos you need, you have to hold more than you need. And you also might have a pile of euros in Europe and a pile of dollars in the United States and so on. The advantage of using a digital asset is you can hold a big pile of your local currency. You can hold a big pile of dollars, and you can convert that into whatever currency you need immediately in the destination country. So if you need Mexican pesos in Mexico, you can have them in less than a minute, anytime, day or night, holiday. And so that creates a great experience for customers where they don't have to pre-fund, all around the world. They don't have to anticipate which corridors they're going to need funds in. Again, that's a regulated institutional product. The big thing about it from Ripple's standpoint, and the reason we built it, is because it can, settle with a cryptocurrency. It's also a distribution channel for enterprise DeFi. Like Ripple's company strategy on the Ripple Net side, especially, is around bringing institutions access to DeFi products and services that probably not existing ones that won't meet the regulatory requirements, but future like true DeFi applications that can meet the regulatory requirements. And this is a distribution channel of companies that are already running our software in their payment flows. And so like lending products, real world asset, like tokenization of securities, tokenization of financial products, serving future customers, through crypto payment channels and crypto on crypto blockchains. These are financial institutions that are already running Ripple software right in their payment and customer flows. In the early days, we would pretty much just take anyone who wanted to do anything, because we just wanted to get as much volume as possible so that we could be strategic later about what corridors. And then we looked at what corridors, first of all, where a digital asset would be competitive. So if you have a shortage of customers, you'll take anyone who walks in the door. But when you have your choice of who you're going to target, you think about what makes the most strategic sense. And obviously, we built the network to settle with XRP. So we're like, let's find customers who are, have the best candidate to settle for XRP. And we just targeted non-bank financial institutions. Banks, obviously, getting a big bank is a huge score, but they're very slow movers and they have the least appetite for risk. And most importantly, they're the least agile So what's going to happen is, like, even if we gave them a product or service that could provide benefits to their customers, they generally won't provide those benefits to their customers. There's a variety of reasons why they won't do that. One of them is that, like, then they're sort of dependent on us, and if our service stops, they have to tell their customers that they're going to get worse service. No bank wants to take that risk. The other problem is, imagine if your bank told you that some of your payments would be fantastic. You'd be like, well, why aren't the other ones fantastic? We couldn't do everything. And so we focused on businesses that could become Ripple success cases, where they would say, hey, Ripple, where it was a good fit, we said, look, here's a case. You're doing remittances in the United States to Mexico. You could settle with XRP. It makes sense. And then you could provide better cost and better features for your customers. You could provide them, better telemetry of where their payments are, or services on days and nights and weekends when they wouldn't ordinarily get services, where they'll push the benefits all the way down to the customer. So we focused on the customers that align with our strategy. And that initially that was non-bank FIs, largely remittance use cases where they would be willing to settle with XRP, where it made sense for them because we had sort of, we could choose who to target. And so now, I think certainly all of our new customers are customers who are using digital assets of some kind to settle. XRP doesn't work in every corridor, and it isn't always the most economic. And we made a decision that, like, we wouldn't turn a customer away because they couldn't use the model that, like, we like best. Like, we want to give our customers the best experiences. We want to provide them a vast array of services, and then it's on us to make the technologies that we want work the best, where the markets are. And so that's kind of where we are now.
Okay.
Banks, it's very sexy when you close a deal with the bank, and we do that sometimes, but they're very slow movers. They're very slow to execute. They're very conservative. They're never going to be Ripple success stories, and it's hard to get them to push the benefits down to their customers because that's risky for them, and then it highlights where they're inefficient. So we focused a lot on banks in the beginning just because a press release with a bank is a big thing, but we discovered they're just very slow to move. Like, if all they want is a press release, now we're like, hey, like, we want to actually, like, move billions of dollars now. And they're like, yeah, we kind of don't. First of all, I think that it isn't a winner take all kind of universe. I think stablecoins are big in DeFi ecosystems for a number of use cases where you do need an asset that's stable, and you also need an asset that's the asset that you think about. Like, I think about my net worth or how much something costs or how much I made from something in dollars. And when I can hold a stable coin denominated in dollars, the value is sort of fixed. And there's obviously a lot of use cases for holding something that has that sort of fixed value that you don't have to really worry about, like fluctuation. And I think that there's not going to be just one, because we have these decentralized blockchains like the XRP Ledger, like Ethereum, and if one stablecoin becomes, like, dominant, then it sort of destroys the advantages of the decentralized, like, counterparty free blockchain. If you have this one counterparty that, if they collapse or have some sort of shock or their asset depegs, they sort of devastate the entire DeFi ecosystem. So I don't think it's a winner take all. I think there's different jurisdictions. I think, like, Tether is sort of jurisdictionally different from Circle. There's advantages and disadvantages. Ripple will be sort of jurisdictionally different from Tether and from Circle. And so it'll not only be another choice, but it will also be different in ways. The sort of risk profile will be different. And so I think there's room for multiple stablecoins to be successful. I think there's a sort of a lack of good tokens on the XRP Ledger, particularly good stablecoins. It's not that there aren't stablecoins. There are. GateHub has one. I think Corium or Sologenic has one. But having, like, really good stable coins, I think, evidence has shown on other blockchains that they increase the utility of the DeFi ecosystems on those blockchains. We have a feature recently launched on the XRP Ledger called the AMM. It's an automated market maker feature that works together with our decentralized exchange. And you have to have, you can't, in order to trade between two assets, you have to have two assets. And where things work well is when you have a volatile asset and a non-volatile asset. And for people who want to hold funds, over a period of time where they're not doing any of those funds, or you want to use funds for collateral, like if let's say you're doing fancy DeFi stuff and maybe you've got loans and you've got digital assets that have movement, but you need collateral to sort of cover, your potential losses, like a margin account. Having your collateral be volatile makes it just, it's not a great experience for people. So we definitely think that like having a high quality stablecoin on the XRP ledger will help to make DeFi use cases like the lending protocol and like the lending protocol. You want to borrow dollars probably. Like most people, you only want to borrow a digital asset if you're doing something really weird. Like I mean, if you just like want to borrow money for like the reasons people normally want to borrow money, like you don't have money right now and you want to buy a car, you don't want your debt denominated in a very volatile asset unless you're like unless you're in a very unusual situation where you really like risk, right? You want that debt denominated in dollars or in your local currency. So we think that like having a high quality stablecoin both on the XRP ledger and in other places, on the XRP ledger, we think it'll turbocharge some of those DeFi use cases like lending real world assets. Like if you sell a real world asset, you don't want to have to hot potato out of a digital asset because you didn't want if you want the exposure to digital asset, that's great. But we want people who don't want exposure to digital assets to be able to participate in these DeFi ecosystems so they can grow as well. And it's not a pivot away from XRP because the XRP is the XRP ledger's like native token. It's its gas token. It's what you pay transactions fees with. And the XRP ledger has features like auto bridging that kind of put XRP in a central role, providing liquidity between other assets. And so the more other assets there are, the more opportunities there are for XRP to bridge between those assets. USDC is essentially it has a United States jurisdictional nexus. Tether doesn't have a United States jurisdictional nexus. It's a little more complicated. So depending on like what your risk profile is and what your sort of like if you're a US regulated company, it might be easier for you to, use USDC rather than Tether or to hold it. Or you might need to diversify because you might be able to, there might be too much risk in holding a large amount that's got, these different profiles. And so it's a different risk profile. Like, if you're an enterprise company, you're not just going to hold a stablecoin. You're going to do a risk analysis. You're going to look what licensing do they have, what jurisdiction are they in, how much revenue do they. So Ripple has a tremendous amount of money in their, on their balance sheet. Ripple has an enormous amount of capital, just sitting around. That helps to create, that helps to create trust. And then that this, it's just a different risk profile. The stablecoin will be in a U.S. jurisdiction. Ripple will issue it using its money transmitter licenses. So the way the stablecoin will work is that Ripple will issue it to to qualified investors who are Ripple customers, maybe Ripple Net customers will be able to get the stablecoin directly from Ripple, and that will be done in jurisdictions where Ripple has licenses like U.S. money transmitter licenses or a trust license or something similar, and it'll be regulated by the states that issue those money transmitter and trust licenses. Right. It's a very similar regulatory profile to USDC.
Are there any concrete plans of adding a smart contract, adding smart contracts to Ripple?
So there's two plans to add smart contracts to either like the XRP ledger or the ecosystem. So one plan is a sort of side chain that runs EVM smart contracts. So you'll be able to move tokens between the XRP ledger and the side chain, and then the side chain you could just run Ethereum smart contracts on it. So that will bring Ethereum smart contracts sort of to the XRP Ledger ecosystem, but not really to the XRP Ledger. You would still have an account either on the XRP Ledger or the sidechain. If you had both, you would have asset. It's not a seamless experience of like just being able to launch a smart contract right on the XRP Ledger. There's an approach that was developed completely outside of Ripple called Hooks, which is a WebAssembly-based smart contract platform. It's not EVM compatible, but it's built in the sort of XRP Ledger spirit of keeping things fast, cheap, and secure. It's not quite as powerful it's not compatible with EVM, so you would have to implement your smart contracts again. And it's not quite as powerful. There's some things that you can do in EVM maybe that are just maybe not as good a fit or maybe not super easy to do, but it will allow a significant subset, maybe all of the important DeFi use cases to be implemented without having to, update the ledger itself. But that's for the future. That's developed. It's running on real money on a parallel chain called Zahao. And so that's good. That's buying it the kind of real world testing data that you need before you risk like a multi-billion-dollar blockchain on like a radical feature. So that's, it's sort of building up that battle testing because the sidechain doesn't require any significant changes to the XRP ledger itself. Hooks is a radical change to the XRP ledger itself, so it's a little bit more complicated. There's a little bit more risk involved and a little bit more buy-in, that we would have to get. One of the things that you have to remember with the blockchain is like there's a heavy preference for not changing it, because one of the things that makes blockchains great is that you can rely on them working like 2 years from now the same way they were. You don't have to worry about Bitcoin like breaking while you can go away for a couple of years and Bitcoin will probably be exactly the same when you come back. Ethereum, it might change a little bit. It migrated from proof of work to proof of stake, but your stuff is still going to work. Like there's this heavy, that part of the value comes from being able to rely on it. And so making radical changes is very difficult to do. And there's a lot of people whose current feeling is like, even if this is a significant advancement, even if it does make it better, the bias against change is very like, why didn't Bitcoin adopt smart contracts? They could have, but they didn't, because like there's value in having a system that is what Bitcoin is, right? And Ethereum is the smart contract platform. And so it's one of those decisions of like, is there value in having it being what it is?
What do you think?
I think that there's enough benefit from allowing some smart contract features that having none at all is probably not the right. There's sort of intermediary. You can go. You think of XRP, like Bitcoin is at one extreme. It doesn't do anything but move Bitcoin. Like people have made it do things with ordinals and inscriptions, but they're really jamming a square peg in a round hole. And on the other extreme, there's blockchains like Ethereum that are completely flexible, and you can upload a contract that does pretty much anything you want, but they have cost issues and security issues. And I think you can maybe stage sort of intermediate positions where you can have some level of flexibility so that you can implement some, reasonable new features without having to get buy-in from the entire ecosystem. And that's kind of what we're trying to think through. And in fact, when Hooks was first implemented on Zahao, they kind of had a switch that they could turn it up in sort of how much power they gave the smart contracts. And as they get more confidence that the system is secure and they're not breaking their consensus algorithm, they're not like blowing up the CPUs, like everything's working fine, they're allowing the smart contracts to sort of have more and more control over what they do. And I think that kind of conservative approach is probably good. We don't want blockchains to be quick to change, particularly if they're worth billions of dollars, because it's hard to fix them if you break them.